Hello everyone, this is Ken Martinez with Mark Investments, introducing the first video in our series of the cash flow calculator. What is your money go? Let's go straight to the savings tab. This first tab, it just illustrates how much money you're going to end up with investing at a specific interest rate up here, starting at one of these ages and ending here, and investing this amount. So as mentioned in overview, all the blue cells are input cells. If you didn't want to look at 8%, but rather 5%, just go and enter the number and everything will just change automatically. And if you want to go back, just go back. In this tab, if you didn't want to end at 67, maybe you wanted to end at 65, just input 65. Notice though, depending on what you end up here, these columns on the right may disappear, and that's because if it doesn't make sense, like starting at 65 and ending at 65, that doesn't make sense, so they will disappear. But you can choose different ages. It doesn't have to be, a round number or end in 5. You can choose ending at age 43, and again, these don't make sense anymore because of when you're ending. And the way you interpret that is if you invested $50 at 8%, starting at age 10 to end at age 43, you'd have 97,327. That's how that is. And if you just same thing like you did over here, you don't have to necessarily start with a number that ends in a 0 or 5. You could do $23, for example, and it would work the same way. The other thing we can do is if instead of using it for ages, you really could just use it for a time period, because that's really what it's doing. It's really subtracting these two. So for example, let's say we just want to know for 1 year, then just put 11 here. It really doesn't matter how old you are. All this is saying if you started at age 10 and ended at age 11. So it's just saying for 1 year, if you were investing $50 a month, at 8%, you'd have $627. And if you want to do 2 years, you could just do 2 years, and it would work the same way. It doesn't really matter what the starting age is. So you can do it by age, or you can just do it for a certain number of years. And that's how this tab works. The next tab is the rule of 72. And this is showing a nice table of everything calculated for you for multiple interest rates. And for multiple growth. It's not necessarily just double your money, which is the rule of 72, but maybe triple your money or 250%. Anything you'd want to calculate for. There is a selection up here. If you want to look at months instead of years, just hit the drop down and this will do everything in months. Because you're compounding more frequently, you will hit your growth percent earlier. But for the purpose of this, let's just go ahead and keep it at years. And it works just the same as before. We know the standard interpretation. If you at 9%, it'll take around 8 years to double your money, or about 10.6 years to have 150% growth. But you can do something that's not listed on the chart. You can do 5.2%, and you could do 78%. And what that's saying is that 5.2% to hit a 78% growth would take about 11.4 years. So you can mix and match anything you want here, and it'll tell you automatically how many years it'll take. And that's the rule of 72. Let's spend the most of our time though on the compounding, because this is really quite a powerful calculator that I've built here in Excel. And let me just explain what this is telling you. It's going to tell you how much money you'll have at the end of a certain number of years, anywhere from 1 to 40, with these input parameters, and then it's going to show you the variation among the frequency of compounding to show you how that affects the growth over time. So like before, we do have input cells. If let's just start out with 8%, but if you wanted 5%, you certainly could do that. We'll just leave 8%. And starting out with a $5,000 investment. And down here below in this table here, you can see in year 0, it's 5,000. That's just going to take this number down here. And let's pause for a second. Let's show you that everything is actually already calculated in this big table here. And all this really calculation is doing is that whatever year you put in here, it's kind of just doing a quick little lookup down here on row 35. And then it's going to bring it up here so you can see, so you don't have to really bother scrolling. Anyhow, let's see. So we have 5,000 initially, and then every year we're going to input 1,000, and then you can calculate the impact of inflation. Right now I have 3%, and just whatever you feel inflation is, just go ahead and put that number is. So then we have the impact. How much money are you going to have at the end of 35 ignoring inflation? And we'll just look at this monthly column. So what this is saying, your interpretation is 5,000 initially, 1,000 every year at 8%. In 35 years, you'll have almost 274,000. Because you are compounding more frequently, annually, your APR annually will equal your initial nominal rate. But if you compound more frequently, this increases, and then so correspondingly, your dollar amounts are going to increase because of the frequency of compounding. The more you compound, the better it is for you. And then I have a graph over here showing the differences, and of course I do have simple interest, which is way down because there's no compounding. But you can see the differences over here. And then let's look at with inflation, though. The way you interpret this number is, I'll go ahead and look at monthly still. So what we're saying is without inflation, you have this much. But if you want to include the impact of a 3% inflation rate over these 35 years, what you're really going to have is the buying power of about 97,000 today, not 270, almost 4,000. So that's because your inflation is really going to affect your interest rate. So instead of earning, say, 8.3%, you're going to earn really 5.1% with inflation. So much lower number, and I do have that shown here in the this light red color, rust color. So you can dramatically see the effects in this graph here on the right, the effects of inflation and what that does. But let's say for a minute here that you really did want this amount of money 35 years from now, and you want that much money as if you were purchasing today. You want today's buying power. That's what these numbers are. If you wanted the buying power of 274,000 35 years from now, this is what you're really going to need. And all I'm doing is I'm using this inflation factor as a discount rate to go up or down depending on what we're looking at. So that's what you need. And if you needed to reach that goal in 35 years, what you're going to really effectively need to earn on your money is 11.6%, not the 8.3%. So again, that's interpretation. You would need to have 770,000 in 35 years to buy what 274,000 is buying today. So without inflation, with inflation, and with inflation with the same buying power as these numbers. That's how you interpret those. So I know that's kind of a lot right there, but I think this is vital information because inflation is going to impact all of us. Let's just run through a couple of scenarios. So notice right now that we have compounding daily is actually the highest. What happens if we just change this to 1%? So the differences here now, if you notice, they're all pretty same. Since we have such a low interest rate, we're not really actually doing much better than simple interest. It's all pretty close. In fact, compounding annually is actually higher than compounding daily. And that's because of this little box. We're doing a low interest rate, but we're either, what this tells you to do is all the money going in on January 1st or once, or is it going in every time you compound? So because we have a low interest rate, on annual basis, that's the only scenario where you have all of your money in for the full year. So that's the reason why compounding annual actually ends up being the most. If you really wanted to offset that fact, you would really need a larger interest rate. And now because of the large interest rate, now you end up having more compounded daily than you do annually because your interest rate is overcompensating for the fact that even though all your money is here initially for the whole year, you have a large interest rate and the compounding really affects everything. If you just wanted to put everybody on equal footing here, you could say I want all the money to go in on January 1st for every compounding situation. So notice here on the daily right now it's 486, 582, and because you have a full year of compounding for all of these, now they went up and actually the difference ends up being more dramatic. So I have given you an option to say do I want the money for every scenario on January 1st, the beginning of the year, or do I want it, like in 12 equal payments or 4 equal or 2 equal payments or whatnot? Choice is really up to you on how you want to do that. And that's pretty much it for this. So very powerful. You can mix and match all of your different scenarios with inflation, without inflation. You do have a graphical, and then if you actually want to see the numbers, just look down here. And that's it for compounding. Let's go back to here. And again, this is Ken Martinez with Mark Investments. And if you want to learn how you can invest in this calculator for your own business, just send an email to mark55llc@gmail.com. Thank